Okay, guys, so real quick, I'm going to go through these and hopefully this will make some sense to you when we go back through it like this, okay? Now, again, if you remember talking about different types of bank accounts and saving goals, there was checking account, savings account, certificate of deposit, money market. When it comes to starting a savings plan, it's figuring out how expensive something is and seeing how long it would take to save. So it's essentially just devising a plan and following it. Your checking account is your quote-unquote spending account, all right? It basically, it's called checking account because people used to write checks from it, all right? That's where the money you're spending on a daily basis goes. Your savings account is a place where you keep money for intermediate reasons / emergency fund. There are limits on withdrawals. It does earn a little bit of interest. A certificate of deposit is a timed savings account, okay? Meaning you promise to leave your money in for a certain period of time for a guaranteed rate of return. Varies in length. You can still access your money if there's an emergency, but you must pay a penalty to get your money out of a certificate of deposit. Money market account is a fancy savings account that pays interest at the current quote-unquote money rates. Honestly, the best way to think about it is that it's just like a savings account that pays slightly more in interest. All of those accounts are insured, meaning that if your bank fails, your money is guaranteed by the Federal Deposit Insurance Corporation. Now, creating a savings plan. Basically what you're going to do is you're going to take something you want to purchase, say a new TV that'll cost you $500, figure out how much you can save per month, and figure out how long you'll need to save this thing to buy, in this case 5 months, save your money, then buy it. So it's just devising a plan and following it, that's all. Now when it comes to budgeting, budgeting allows for you to make a plan for your money. So you are essentially ahead of time divvying up where your money is going to go and saying, hey, this is how it's going to be. Everyone manages money. A budget allows for you to do it well, allows for you to have a plan, okay? There are a lot of budgeting apps to help you with this if you want. Pen and paper work, Excel works, whatever makes sense to you works. But by making the plan, you can free up more of your money. So it's really important that you do so, okay? Having a plan is really important. Now, for credit, moving on into credit, your credit score rates your ability to borrow and repay money. So when we say credit, we mean borrowing money, okay? Now, to build your credit score, there are some different things you can do. You can pay your bills on time. Don't open too many credit cards at once. Be gradual with it. Purposeful. Only open up a credit card if it's something that you really need, okay? Credit agencies also like to see that your debt utilization ratio is under 30%, meaning that you don't borrow more than 30% of your money on credit cards that you can. So if you have a $10,000 limit on a credit card, do not borrow more than $3,000 on that credit card, and then pay it down, and you can borrow back up to it. Pay off more than minimum payments each month on credit cards. You can even pay them all the way off if you want. That way you don't have any interest. That'll still build credit up, okay? Now, types of credit. There's what's called a secured loan, which is where there's an asset like a car or a house, and those loans are backed by that asset, okay, that is used as collateral in case you fail to pay off the loan. You can also use something you own outright as collateral. So let's say you own your car, you bought it in cash, but now you need a quick loan to pay for school or whatever. You can use your car as collateral, meaning if you don't pay that loan back, the bank has the right to come and take your car, okay? An unsecured loan is where there's no asset as collateral. So a credit card is a great example of an unsecured loan because the things you buy on credit cards, there's nothing backing up that money. That's why the interest rates are usually higher too, because it's riskier for banks to lend you money on a credit card. Now, managing your debt, if you utilize debt, which you don't have to, meaning if you borrow money, follow these steps to make sure you don't get into too much trouble. First of all, pay off as much as you can towards your credit card each month. If you can pay it all the way off within the budget, do it, because that'll make your life easier. Seek out credit cards with the lowest interest rates from the beginning, okay? Don't borrow too much. It's easy to swipe the credit card and make your payments and think you can cover it all, but really, credit card debt adds up very quickly, okay? Now, insurance. Not very fun to think about insurance, but it is a very important part of being financially successful. So the 5 main types are auto, homeowners, renters, health, long-term disability, and life insurance. Why you buy it? Because it protects you from accidents costing you money. So imagine if you didn't have homeowners insurance, you owned a house in Wiley and that giant hailstorm hit 6 years ago, and your whole roof and parts of your house were completely destroyed, and you would have had to pay for that all out of pocket. But because you have homeowners insurance, then hopefully then you don't have to do that. Now, when it comes to renting versus buying home, Some pros for renting. Okay, first of all, less upfront costs, more mobility, you're more freedom. Aren't responsible for maintenance or repairs. You can build your credit. There is no property tax when you do that. Cons of renting a home: there's instability in rent payments, limited options depending upon your preference. You might have to move more frequently. There's no equity and no tax benefits. Okay, so some negatives to renting as well. Buying a home, so pros of buying a home: you may build equity in your home and your credit score, freedom to decorate, paint, make improvements, more stability, potential tax benefits. Cons: it requires down payment, a lot of paperwork and stress to buy. You could lose your money. There's more expenses beyond the mortgage payment you have to make every month, and you're responsible for repairs and remodeling. Okay, now I know I'm moving fast, but pause, rewind if you need to. Investing. For long-term savings goals like retirement or money growth, you want to invest your money because you want your money to grow in value to outpace inflation. Okay, you want it to grow faster than it's losing value. That's why people invest their money. They want their money working for them. Okay, typically when investing, the higher the risk, the higher the potential reward, because the chances of losing money is so much higher. Okay, so be careful making risky investments, but should it work, it can work. Most people invest in the stock market. It's a place where stock ownership in companies is bought and sold. This is done through brokerage accounts and retirement accounts, and the money is not insured. So if that company goes under or loses value, you've lost your money. Now, things to invest in, okay, stocks, bonds, commodities, and mutual funds and index funds. So stocks are individual companies like Google, Tesla, Snap, etc. that sell shares that you can buy and sell. These are extremely volatile. I mean, you can go up and down a lot each day. And sometimes it doesn't really make sense what's happening with the stock price. Typically, it's supposedly based on the value of the company, but sometimes things can get a little irrational with it, but that's okay. Bonds, okay, you buy debt and the company or government pays you guaranteed interest rate on that money plus the principal at the end. So if you get a $1,000 bond, right, they pay you interest on that $1,000 for however long the bond term is, sort of like a CD, and then at the end they give you the principal back as well. Okay, commodities, things like oil, natural gas, gold, silver, super extreme volatility. I added the extra super extreme because it goes up and down a lot. Just look at the price of oil this year has been. Why? I mean, at one point it was actually in the negative price, meaning you had to pay people to take oil off your hands. So, which I've never seen before, but that was wild. Mutual funds, index funds, these are collections of stocks and bonds that you invest in. So essentially you put your money into the fund and then managers of that fund buy those stocks. And then based on how those stocks do, reflect how well the mutual fund does. Okay, this provides diversity at a cheaper price, because if you wanted to go buy Apple, Google, Amazon stock individually, you would need to have thousands of dollars because of the expensive price of those shares. Or you could put a couple $100 a month into a mutual fund. Then they take that with other people's investment, pool it together, and there you go. Retirement accounts, again, these are types of accounts with different tax advantages that people save money for retirement. Okay, two main ones that people invest in. There are others, but the two main ones, you have your 401k, both a traditional and a Roth 401k are available usually to most people. But basically a 401k is typically offered when you start working somewhere as a perk for your employment. You save money in, and your company will usually also contribute a portion of that in. They'll either match it up to a certain percentage, or they'll do something to help you out with that. Once that money is in the 401k, you then choose how it is invested, whether that's in stocks, mutual funds, whatever it is you want to be doing. Individual retirement account, you do this on your own, separate from the employer, but works similarly to the 401k. Okay, so you do it on your own. There's no company match, there's no anything. You put all the money into it. Now, two main types of each. You have your traditional and you have your Roth. A traditional, the money grows tax deferred, meaning you don't pay taxes on it today, the money you put in, but you pay taxes on the money you withdraw later. A Roth, that money grows completely tax-free because you don't get any tax breaks today on it. But when you go to take it out, it's all tax-free money. Okay, so hopefully this helps. If you have any questions, write them down and let me know.